So next up, we have three paper presentations by four experts. The first paper introduces the idea that there may have to be a balance between the global rules and the principle of vertical equity. The next two papers then provide some practical insights on the impact of globe rules relating to Asia. The four paper presenters are in order: Mr. Matt Andrew, who is a teaching fellow at the University of Auckland and has had many years of experience in both public and private practice in many jurisdictions around the world. He's also a member of the Asia Voices Working Group with us. After that, we have Dr. Mona Barake, a postdoctoral fellow at the EU Tax Observatory and the Paris School of Economics, whose research is on tax havens and tax avoidance. Then we have Mr. Ivan Lazarov and Ms. Belisa Liotti, who are researchers at the Vienna University Global Tax Policy Center at the Institute for Austrian and International Tax Law. And they will be co-presenting their paper on tax incentive regimes in Asia and how they might be affected by Pillar 2. They'll present their thoughts first in order, and then we'll have some time for Q&A and discussion after that. As before, please submit your questions and comments via the Zoom Q&A function. So Matt, over to you.
Thanks very much. And look, and just starting off, this paper is based on my research, doing my PhD, so it represents my own views and not any other institution that I'm connected to. So just wanted to note that. Yeah, look, I think the purpose of the paper that I've been writing is to really look at the role of vertical equity in the context of implementing the globe as defined by Jay. And so to me, the globe, having worked at the OECD, really does has characteristics that really appeal to makers that favour economic efficiency as the dominant criterion in the development of international tax policy. And that's because it really reduces the influence of tax on business decision making, and therefore is really focused on capital export neutrality, capital import neutrality, and doesn't really address any issues connected to vertical equity issues for developing country rights to apply tax incentives in order to compete on foreign direct investment. And I would sort of say, having worked in Asia a long time, tax incentives have always been a fundamental part of Asia developing country response to compete with developed countries. And I do acknowledge Jay's comments around there are other issues, other factors which should be focused on in terms of what I would refer to as domestic resource mobilization instead of use of tax incentives. But I do think competing on education and infrastructure with developed countries really does fly in the face of vertical equity. And I think is unfair and may even exacerbate in the short term developed and developing country wealth gap. So the paper really argues that vertical equity has been ignored in the development of the globe rules, even though vertical equity has been a fundamental part of the development of domestic tax policy. And that is, while it's always been given the credence, vertical equity hasn't been given the credence of efficiency, which has really been the lone star of international tax policy. The paper argues it still has actually an important role in the context of protecting developing country interests, and then really sort of noting that there should be some flexibility in terms of the implementation of globe to reflect that vertical equity issue. So it could even be on a temporary or sunsetted basis over a period of time to allow countries to work on other investment factors, as mentioned by Jay, so that they, and not just really arbitrarily imposed in 2024 by the inclusive framework, which is when effectively incentives will be switched off at least to 15%. Next slide, please. Look, just a quick note. Again, the globe rules are really designed to ensure that large multinationals pay at least 15% on a jurisdictional basis, and that's through the application of the top-up taxes that Jay's already mentioned. So the globe rules are really expected to impact income-based taxes, and therefore exemptions and tax holiday schemes aimed at temporarily eliminating income taxes through the application of the GLOBE and the top-up tax in the ultimate parent jurisdiction. And there's a paper that was recently released on Pillar 2 called Tax Incentives in the Global Minimum Corporate Tax, which was released by the OECD. And the message from the OECD to jurisdictions is you need to look at those tax incentives, those corporate income tax incentives now, and get ready to change and switch and be prepared to understand the impact of them being effectively switched off by the GLOBE. At least to that 15%. Next slide, please. I think what's also clear as well on the next slide is that the new incentives will also be difficult to implement to circumvent the GLOBE rules, and the paper really refers to paragraph 126 of chapter 10 of the commentary to the model rules that states a tax benefit or grant provided to all taxpayers and is not related to the GLOBE rules, it is still allowable if it's to 15%, and sort of really says, the paragraph really reiterates the point that a factual assessment is critical as to whether a benefit is being provided, and really sort of notes the follows, whether it's whether a qualified income inclusion rule, and I assume we don't know yet, a qualified domestic minimum top-up tax, an incentive may disqualify the income inclusion rule or domestic minimum tax from being qualified if the tax benefit or grant is only to taxpayers subject to the GLOBE rules, whether the benefit is marketed as part of the GLOBE rules, and if the regime was introduced after the OECD G20 inclusive framework started discussing the GLOBE rules. And so what's clear is that from a qualified income inclusion rule is that tax incentives cannot be developed specifically for the GLOBE rules. And then paragraph 127 of the chapter also confirms the inclusive framework will implement a process for tax administrations to determine whether one of those incentives may disqualify the income inclusion rule. And so it's clear what the GLOBE rules really seek to essentially achieve is to eliminate tax competition through the introduction of a minimum tax, and hence reducing the impact of tax as a deciding factor of where a multinational invests. And that's clearly an efficiency driver, and doesn't consider vertical equity in its construction. Next slide, please. And so given the dominance of equity over efficiency in the development of modern income tax, it might surprise many that the international tax context, efficiency is really tended to dominate. And that's really from the beginning, which, as I've mentioned, it's the theories of capital export neutrality and capital import neutrality, which has really driven the GLOBE rules and the construction of the international tax system. And so the really important point in relation to economic efficiency and international tax is tax rate competition, and we hear that a lot. We heard that a lot from the OECD in the documents and their publications, etc. As the GLOBE rules are really being developed to stop the race to the bottom. And that's because it's considered to distort decisions on how to use resources and creates economic inefficiencies. And however, I would sort of note the GLOBE does not address the vertical equity issues connected to developing country rights to apply incentives in order to compete for foreign direct investment. And the paper argues that vertical equity has been ignored. And actually vertical equity still has an important role to play in the context of international tax policy setting to protect those developing country interests. And that may not sound as ludicrous as it sounds to you probably now. And I think on the next slide, we really see that vertical equity in the context of international tax does occur actually, and we see examples of it occurring in probably three areas. We see specific examples in the context of treaties. We see some international tax theories, vertical equity theories of international tax, and we see examples of vertical equity in Pillar 1. So it's not actually as ludicrous as it sounds. And so on the first point, on the treaty point, we see the EU's move towards more equitable treaty terms with developing countries, which have since been adopted by some EU countries in their policies. For example, we see this in Ireland's tax treaty policy statement, which came out in June 2022, which incorporates taking into account any potential impact and negative spillovers to treaty counterparts. It's also worth noting the Netherlands has offered to renegotiate treaties with developing countries to include anti-abuse clauses. Secondly, we see some literature on international policies and vertical equity. The most dominant of this my paper explores this as a theory of internation equity, and that's the concept of international equity begins by looking at the baseline concept of national gain and then determining whether there should be a departure from that baseline on fair or unfair basis. The second step is that internation equity then allows for departures from the baseline of tax base attributable to national gain to account for factors such as disparities in labour, capital, natural resources, and other attributes of different countries. There's also some literature which has come out where the literature has argued that countries that disproportionately benefit from international economic systems owe an obligation to transfer revenue to the countries that do not benefit as much from the tax system. And there's some interesting theories, such as tax sparing and targeted capital investment neutrality. In the past, proponents of international vertical equity have supported proposals, these sorts of proposals. For example, there's one proposal in the literature which generally refers to as tax sparing. A developed country would specifically be exempt income earned in developing countries from its corporate income tax altogether. Under another, the developed country would adopt a targeted kind of corporate CIN type policy for income earned in developing countries, while continued capital export neutrality type policy for income earned elsewhere. And so the proponents of this approach contend that foreign direct investment stimulates growth not only from directed benefits of investment, but also from positive spillover effects, which come from that, such as infrastructure development, worker training, increased tax base, and other similar benefits as well. So there is some literature that is looking beyond efficiency criteria to suggest vertical equity is an important consideration in the design of international tax system as well. And then I would say thirdly and lastly on that point, we also see elements of vertical equity in the context of Pillar 1, and which is being developed right now. And so we for example, we have the small and developing country nexus threshold, which is euro $250,000. That creates a nexus for amount A versus the euro 1 million for larger countries. We also see in tax certainty that the fact that developing countries can opt out of mandatory and binding tax certainty for issues related to amount A, such as transfer pricing, whereas developed countries cannot. Accordingly, I think that there really are vertical equity theories in existence and aspects of Pillar 1 that seek to support developing countries in relation to their sovereign tax base. And that's the sovereign theory. And there are also theories to support developing country improvements through international tax redistribution, such as tax sparing and tax arbitrage harnessing. Next slide, please. So I'm really, lastly, really sort of saying, in terms of my paper sort of suggesting that it's seeking to apply principles of vertical equity in the application of the globe rules, perhaps as an approach which could be taken for specific developing country incentive regimes, which could be exempted from the globe minimum tax if it qualifies. Maybe there are 3 elements of criteria which could apply to exempt those specific developing country incentive regimes. And the first would be to the developing country qualification. And I think we already have that actually in the pillars. For ease of reference, and consistency, the same developing country criteria could be applied for this exemption that I'm talking about as in Article 20 of the Pillar 1 draft multilateral convention, which really exempts, as I've mentioned, developing countries as classed under the World Bank as a low income or lower middle income country, which applies to that exemption from tax certainty, mandatory binding tax certainty for issues related to amount A. So that could be a criteria which is already in the pillars. The second, it should probably qualify as non-harmful under the Action 5 harmful tax practice minimum standard. So it would seem appropriate that any preferential regime to be exempted from Pillar 2 minimum tax should have been reviewed and not considered harmful. And so in this way, this second criteria could almost operate as a filtering mechanism to only select developing country regimes that are already reviewed and considered BEPS acceptable. And then thirdly, it would not otherwise disqualify an income inclusion, an IIR regime as being disqualified. And so, as I already mentioned, paragraph 126 of chapter 10 of the commentary to the rules sort of suggests that globe rules, any incentive should be available to all taxpayers and not just globe taxpayers subject to the globe rules. And so the key point here is that the tax incentive regimes that qualify for the proposed Pillar 2 exemption cannot be developed specifically for the globe rules and must be available to all taxpayers, whether in the scope of the globe rules or not. So in conclusion, I'll finish now. Where I end up on the next slide is these three criteria could be used as the basis to exempt developing country incentive regime from the 15% minimum tax threshold. And as noted above, it may not, the idea is not as outlandish as it sounds, because Pillar 1 already has a number of features that allow for the exemption to the rule in order to recognise different inclusive framework member needs. It does not seem unreasonable to extend this flexibility to Pillar 2 in terms of the tax regimes. On vertical equity gallons, it would seem to be a principled approach. And it is also important to note that while economic efficiency has primacy in international tax policy, vertical equity also has some basis in international tax, i.e. tax barring, tax harnessing. And then lastly, to ensure country needs and imperatives are met, this tax incentive regime, tax regime exemption would seem to have merit, as attracting foreign investment is critical to the economic development of these countries, and as I've mentioned, competing on education and infrastructure with developed countries seems to fly in the face of vertical equity, and actually seems to be unfair, at least in the short term. And there could be some sunsetting for that as we move to that domestic resource mobilisation model that Jay mentioned. So with that, I turn back to Chris and say thank you for allowing me to outline my paper. Thank you.
Yep. Yeah, thanks, Matt. And I think a lot of food for thought there, especially with your recommendations. And we'll come back to it when we have our question and answers as to a few questions about how implementable your recommendations are at this point in time. So next up, we have, as I said earlier, Dr. Mona Barake, and she will present on some of the revenue implications for countries in the region and globally.
Thank you for having me. I'm looking forward to start my presentation. So I'm going to present a paper that is co-authored by Gabriel Zuckman, Theresa Neef, and Poleman Shuk, my co-authors. And so this paper, the purpose of it is to put numbers on this Pillar 2. So how much to know how much each country would benefit or not from this tax deal. Next slide, please. I'm going to skip this because Dr. J. Rosengard gave many context about Pillar 2 already. I'm going to skip also this one. Please, yes. So I'm going to start first very quickly with the related literature, then tell you what data source we used to have our estimates, and very briefly go through the methodology, because we have two different scenarios where we present the estimations. So the first scenario that we take, we assume that all countries will apply the Pillar 2 with the headquarters scenario, so the IIR, the Income Inclusion Rule. And in this scenario, as you know, it's the headquarter country of the multinational who will add this top-up tax of 15%. The second scenario that we will also look at is the QDMTT. And this scenario is where the host country, where the affiliate is, will choose to add the top-up tax itself. So, and then I'm going to present the key findings of these two scenarios and conclude. Next slide, please. Next. So, for the literature, I would say that there's some work that has been done by Devreux and Clausing, Size, and Zuckman, and most the most maybe the largest work has been done by the OECD, which proposed the Pillar 2 in their economic impact assessment. So they also do estimates of the global revenue of the Pillar 2, but they don't give detailed revenues of what each country would gain from Pillar 2. And this is what we're trying to do in our work. Next slide. And next as well. Yes, so arriving to the main data sources. Next slide. We're gonna use the OECD aggregated country by country report. So I'm not sure if you're familiar with this database, but it's a new tool. It's the country by country reporting, which some countries are starting to share their data with the OECD. So so far, there's only 2 years of data, 2016 and 2017. In 2017, there's 38 parent jurisdictions that released their data. So what does this data have? The parent country is reporting what its multinationals are doing abroad. So what are their revenues by country, the profits before tax, the income taxes paid, the tangible assets, and the number of employees. So there's several indicators that are interesting. And there's a broad geographical coverage. So in 2017, there's 213 unique partners that are covered, with on average 49 partner countries per reporting country. And certain parent countries, so they report, they don't report necessarily by, let's say, if the multinational, if Singapore that is reporting, some of them, so it's not the case of Singapore, they are reporting only their profits by continent. And for parent countries also, they are only reporting their total foreign profits abroad. Next slide. This is, for example, Singapore in the OECD country by country data. So we have, this is like a little screenshot showing some of the partner countries of Singapore. We have, for example, the number of CBCRs, which is the number of Singaporean multinationals that are active in Australia, Germany, etc. And you have how much revenues these Singaporean multinationals are having in Australia, how much taxes they are paying in Australia, etc. So this is just an example of this database that we use. Next slide. Because the OECD CBCR only covers 38 parent countries, we don't have a global view on other countries in the world. So what we do is that we add some data that was compiled by Twotier and Zuckman. So they did some work and they created like a database where there's that we were able to use to complement our database. So we moved from 36 parent jurisdictions, which are covered in the OECD data, to 83 unique countries. But this data, with this database, we had to do several assumptions, and working with the country by country data gives usually, I mean, it would be easier and better for the estimations to do it, but because we didn't have any choice, we complemented the data with this source. Next slide. So now the methodology briefly. Next slide. Yes, so first, of course, what is important in this Pillar 2 deal is to estimate the effective tax rates of like by country. So as simple as it is, the effective tax rate that we use in our methodology is the taxes paid divided by the profits before tax. And what we see in our data is that 40% of profits are taxed between 15% and 20%. And the others, so there's around 30% that are taxed between 0 and 15%. And these are the ones, so the first 3 columns, where the Pillar 1 will have an effect. Next slide. So the first scenario that I already mentioned is the income inclusion rule that we try to simulate the revenues for, which is where the headquarter country would collect the top-up tax. So if, for example, we have Singaporean multinationals operating abroad, they will say, okay, we want to collect this, put this minimum tax, and we want to collect the top-up tax from the subsidiaries of our multinationals abroad. Next slide. Now, the other scenario is the qualified domestic minimum top-up tax. And for example, if we stay with the Singaporean example, it's in this case, it's Singapore who will say, okay, we have some subsidiaries of foreign multinationals operating in Singapore. Instead of France taking the top-up tax from the French subsidiaries in Singapore, it's Singapore who will do it because it's the host country. Next slide. Then another important rule in this Pillar 2 is the substance-based income inclusion, or what they call the carve-out. So the carve-out, as you might know, is an amount that the company is able to subtract when adding the top-up tax. So basically, when you want to add the top-up tax of 15% on the profits, you can subtract from the profits an amount which is 8% of the tangible assets and 10% of the compensation of employees or payroll. And this is, according to the rules, this will happen in the first year. Then throughout the years, there's like a 10-year transition period where at the end of it, these carve-out rates are going to be reduced to 5% tangible assets and subtracting 5% of the payroll. So why there's these carve-outs? They were introduced in order to not penalize, let's say, or to reduce the severity of Pillar 2 on countries where there's real economic activity with respect to other countries where there's not necessarily real economic activity. So where there's profits that are there, but very little employees, very little assets. Next slide. Now we arrive to the key findings. Next slide. So in the first scenario, which is where the headquarter country will collect the top-up tax from their multinationals around the world, this will result first, like the total revenues from Pillar 2 are around 179 billion euros. This will decrease to 150 billion euros with the long-term carve-outs. And this estimation is very close to the one that the OECD arrived to at the global level. Now, the carve-outs would decrease these revenues by 22%. For Singapore, for example, if we look at the revenues that they will be able to make under this scenario, it is only about 0.7 billion, and they will decrease to 500 million with the carve-outs, so by 29% approximately. The EU and the US would collect the most revenues under this scenario, with 67 billion for the EU and 58 for the US without the carve-outs. And this is because countries that have very high number of multinationals like the US and that are kind of tax aggressive, so they are putting their subsidiaries in low tax countries will benefit the most from this top-up tax under Pillar 2. Next slide. Next one as well. Thank you. So now under the QDMTT, or the host, where the scenario where the host country will collect the top-up tax, things will change. So we are still going to have the same total as the first scenario, which doesn't change, the 154 billion euros after carve-outs. And what will happen under this scenario is that this amount will be distributed differently, as now the host country will do the top-up tax itself. So the low tax jurisdictions that attract affiliates of many multinationals appear here to be among the main beneficiaries of the QDMTT scenario. This is the case, for example, of the Cayman Islands, which would collect 11 billion, Switzerland 8, Bermuda 8 as well, Singapore 8. So Singapore, it will, under the IRR, it was 0.6 after the carve-outs, and it will move to 7.9 under the host country scenario or the QDMTT. So it's a big change. Revenues collected by the US would also fall dramatically because, and it's expected because they were collecting the top-up tax for their multinationals abroad. They have many multinationals in low tax countries. So their revenues is going to fall from 54 billion euros to 3 billion euros. And then the revenues collected by the EU would not really change. And this is because it's going to be compensated by Luxembourg and some other countries, which the revenues will be increasing. And so, for example, Luxembourg will pass from 5.1 under the IRR scenario to 12.5 under the QDMTT. France will decrease. We'll see their revenues decrease from 0.6 under the IRR to 0.2 under the QDMTT scenario. Next slide, please. Now, getting is so to see how this will how these revenues represent to the whole world. We take the classification of developed countries, developing countries from the United Nations 2020 classifications. We try to see who is going to benefit most under the two different scenarios. So in the IRR, where the headquarters country would take itself the top-up tax, we see that the developed countries would benefit the most. They would be collecting around 86 of the revenues, and the G7 countries alone, they will collect 58%. This is driven by the US because it's going to collect a lot of revenues under the scenario. And developing countries would only collect 14%. Now, if we move to the QDMTT, revenues are a little bit rebalanced in favor of developing countries, which would be around 32%. It's still not very high. If we compare it with developed countries, that would still collect around 61% of the revenues. The G7 members will decrease from 58 to 11. This is because the revenues will be lowered dramatically for the US. And while the least developed countries under both scenarios, they will almost get nothing. So the least developed countries, because they don't have multinationals operating in their countries operating abroad, and they don't also have multinationals that are operating in their country. So in both cases, they're not going to get anything from Pillar 2. Next slide. Now we arrive to focus a little bit on some Asian countries. So, for example, if we take first Singapore, we have, according to the OECD data, of course, maybe this is not, we are not sure how, so these data are normally reliable, but we are not sure how much they represent the reality. But in this data, it says that there's 49 Singaporean multinationals operating abroad. Their ETRs are on average 7.5% abroad. And under the IRR scenario, Singapore would collect 0.6 billion. Now, if we move to the QDMTT, so normally what we also observe in the data is that there is around 1,477 multinationals operating in Singapore. Their ETR is on average 5%, and that's why Singapore, if they apply the QDMTT scenario, they will be able to collect 7.9 billion euros because the ETR that they have is low. If we move, for example, to China as a second example, there's 231 Chinese multinationals. All these data that I'm presenting are from the 2017 OECD country by country database. So 231 Chinese multinationals operating also abroad. They have an ETR on average of 12%, and China will get around 4.4 billion euros under the IRR scenario. If we move to the QDMTT, so we have also around 1,919 multinationals operating in China with an ETR of 20%. So it's higher than the 15% minimum tax. And that's why China will not get many revenues under the QDMTT scenario. So under both scenarios, Asian countries would collect around 12 billion euros. And I mean, not all Asian countries, but the 8 Asian countries that I have listed here: China, Indonesia, Japan, Malaysia, South Korea, Singapore, India, and Hong Kong. 12.5 billion euros, and this is around 8% of the total profits that we estimate for the whole sample of countries. So one thing to mention is that our estimates do not account for behavioral responses, because as you know, maybe when Pillar 2 is going to be applied, some companies are going to move their profits, move their assets, move their employees. So this will affect the carve-outs. This will affect also the amount of revenues both under the IRR scenario and the QDMTT scenario. And I will conclude with the very last slide in this PowerPoint, which is, I think, the slide 33. If you can keep next one as well. Next, it's the very last one. Next, yes, this one. So so just a few remarks on the substance-based carve-outs, because they can shape incentives. So first, could concentrate both their profits and their assets or employees in low-tax jurisdictions, because they were able to subtract more from the profits and decrease the impact of Pillar 2. So this would probably be a response of companies to Pillar 2. Regarding also the possibility for host countries to adopt the QDMTT, it's not maybe very easy, because maybe for some developing countries it would be costly. So maybe some developing countries would lose the ability of implementing the QDMTT for various reasons, which will make them lose some revenues. And finally, on the GILTI, so there's also this debate on how GILTI is gonna coexist with Pillar 2. So something that we try to explore in our paper, not by doing some estimations, just an idea, is that we think that I mean, there's still a lot of debate, but maybe what will happen is that the GILTI top-up tax will apply first. I mean, it will be in something called the covered taxes in the model rules, and this would raise the ETRs computed for US multinationals and thereby reduce the top-up taxes to be collected by host countries under the QDMTT. So if there's the QDMTT scenario, for example, applied in let's say, I don't know, country X, what will happen is that the US will say, okay, we have GILTI, so under GILTI we have the priority. Even if you are applying QDMTT, we have the priority because of this CFC rules and covered taxes priority saying, we will first collect our share because of GILTI, and then this country will collect what they can from Pillar 2. So we can maybe talk about that later in the question period. Thank you.
Yeah, thanks, Mona. Lots to think about as well. I think you ended off by talking about the behavioral aspects of all of this. You shared with us the kind of the revenue and impacts on various countries in Asia, as well as around the world, and clearly the US, as has already been discussed, is material to all of this. But I think, well, let's come back to the whole idea of these behavioral effects. amongst countries, but also amongst the multinationals later on. And I'd like to maybe pose that question to all of you paper presenters later on. Next, we have Mr. Ivan Lazarov and Ms. Belisa Liotti from the Vienna University Global Tax Policy Center. Ivan, are you going first?
No, actually, yeah, Belisa will start and I will chip in after.
Fantastic, thank you. Over to you, Belisa.
Thank you very much, Christopher. Good afternoon, everyone. Actually, good morning from our side here in Vienna. We are delighted to be here. Now I will present the impact of Pillar 2 on tax incentives for the Asia-Pacific region, and Ivan will propose some policy response and perhaps some alternative solutions to this impact for the region. Well, to begin with, we are well aware that jurisdictions in the Asia-Pacific have long been known for the extensive range of tax concessions, which tend to take more the form of income and profit-based tax incentives than expenditure-based incentives. But still, as we can spot from the UNCTAD chart, both forms of incentives, they have been adopted in the region over the past 10 years, and they are usually aimed at attracting foreign investment across multiple sectors, at promoting certain activities, and encouraging business to set up in specific regions, so to develop specific regions or specific activities within the region. Well, on this basis, the minimum tax proposed under Pillar 2, the global rules, they may raise some concerns for the region, and that's what we are going to present now. What is important to know first is that the global rules, they do not expressly prohibit jurisdictions to adopt tax incentives or reduce the rates within their CIT systems. However, based on how the rules will operate, the effects on tax incentives might be, the effects of the tax incentives adopted by countries, they might be undermined as the revenue foregone to the tax incentives might be recaptured in another jurisdiction by the charging of the top-up tax until a minimum effective rate of 15% is actually achieved. Therefore, countries will have to maybe rethink their investment and incentives policies. Well, for countries to assess the real impact of Pillar 2 on their incentives, to then think about the policy response to that, some questions must be answered. The first one is the tax incentive in scope? That is, only tax incentives granted to in-scope MNEs will be affected. So those incentives granted to small and medium companies that do not achieve the revenue threshold under the GLOBE, or for example, to some excluded income in the GLOBE rules, such as income from international shipping, they will not be affected and they can be kept. But if the incentive is in scope, is granted to an MNE that will be affected by the GLOBE rules, then we have to answer a second question. Will the incentive modify the GLOBE ratio, the GLOBE ETR? Well, tax incentives will generally modify the ETR unless the GLOBE model rule says otherwise. So unless the GLOBE model rules recognizing the distinctive nature of some categories of incentives, expressly prescribing the rules some specific adjustments to the GLOBE ratio to neutralize the impact on these incentives. This is the case, for example, with accelerated depreciation, loss carry forward, and participation exemption regimes, which will not or probably not be affected at all by the application of the GLOBE rules. But if the incentive is in scope and this incentive is not regulated by the model, so there is no adjustment to the impact that this incentive might have in the GLOBE ratio, then the tax incentive is assessed to be generally affected by Pillar 2. However, the magnitude of the impact depends on two key factors. The first one is the impact of the substance-based income exclusion, the carve-out, on the top-up tax calculation. And the second one is on the category and design of the tax incentive. So analyzing first the impact of the substance-based carve-out? Well, so the first thing that countries will have to do is to assess the degree of the impact on different sectors and areas. So the degree of impact on specific incentives, they depend on this mitigating effect of the carve-out. The carve-out, as Mona has said in the previous presentation, allows the exclusion of a fixed return, which will be 5% in 10 years, on payroll and tangible asset costs from the calculation of the top-up tax, making the ETR higher for the jurisdiction. So, for example, corporations that rely on labor and tangible asset intensive activities, such as those in the manufacturing sector, they are likely to benefit the most from the carve-out. Thus, incentives granted to these companies, they might be less affected by GloBE because of how the carve-out operates and change the GloBE ratio. On the other hand, sectors and areas that don't necessarily rely on labor and tangible asset intensive activities, such as the ICT sector, technology and innovation businesses, and the financial sector, may benefit less or hardly at all from the carve-out, making the incentives granted to these sectors and areas less effective. So they will probably be more affected by the application of the GloBE rules because they will not benefit as such from the mitigating effect of the carve-out or as much as they should benefit. Then countries, after analyzing whether the sector or activity benefit from the carve-out, they will have to assess the degree of the impact on the specific type of the tax incentive granted. Well, as I mentioned earlier, some incentives, they are explicitly regulated under the GloBE rules and will not be affected, such as the ones that are painted in green here, the loss carry forward, participation exemptions, accelerated depreciation. Other types of incentives that have not been expressly mentioned in the rules, however, they will probably be affected. Two factors determine the impact of these unregulated incentives. The first one is the size, the magnitude of the tax benefit. For example, it will be different if the incentive reduces the tax rates to 0% or if it only slightly reduces the rate below 15%. So the impact will be different. The second factor that will determine the impact is the relevance of the tax base to which the incentive applies in the entity's total GloBE income. For example, if the incentive is granted to just a limited portion of the GloBE income, then the impact might be reduced. But if it's to a large portion, then it might be more affected. But now, looking generally at the potential impact of Pillar 2 on the main categories of tax incentives adopted in the Asia-Pacific region, based on their design, we can assume that full CIT exemption, tax holidays, and reduced rates below 15%, they have the potential to be more heavily impacted because of their magnitude and the potential reduction in the ETR. Thus, in the region, these incentives granted under some of the programs, some of the incentive schemes like the Headquarter Program, the Principal Hub programs, Pioneer Status, Special Economic and High Tax Zones, and some other incentives, they are at risk of being affected. It doesn't mean that they will be affected, but they are more likely to be affected. The impact on other incentives, such as tax credits and deductions, however, is not always straightforward, as it depends on the operation of these incentives. Non-refundable tax credits and super or double deductions, which are common under R&D incentive schemes, they may be adversely affected by the GloBE rules, whereas regular deduction and refundable tax credits, they may face some little or no impact by the rules, depending on how they are structured. Well, before I pass over to Ivan to analyze some policy responses to and alternative solutions to this impact, I just want to emphasize again that what we are showing here in this table depends both on the mitigating effect of the carve-out for the entity and on the weight of the tax base to which the incentive applies in the entity's total globe income. So it's not the impact on tax incentives is not clear under the global rules. It will depend on a case-by-case analysis on the type of the tax incentive. Ivan, to you.
Thank you, Belisa, and good morning on my side as well from Vienna. Now, the question is, what do we do with all of that Belisa just presented in terms of impact? And our point here is that one should always start with some sort of a two-tier evaluation that Belisa already hinted on. And this two-tier evaluation starts with the very basic question of, is the area of the incentive at all substantially affected? Because if the answer to that question is no, then probably the policy response will be one. And if the answer is yes, probably the policy response will be another, and we'll see that in the next slide. But the first and very basic question, of course, is does the type of incentive cover in scope M&Es depending on the structure of the domestic market? And I'll just refer here to Mona's presentation on least developed countries, where we see basically very little impact of Pillar 2. Why? Because there are very little amount of in-scope M&Es on that market. So probably this sort of countries don't really need to do that much in order to react to Pillar 2. The second question is, what will be the impact of the substance carve-out? And in order to understand what will be the impact of the substance carve-out, one needs to ask themselves the basic question of, does the incentive target an area where you have mostly routine profits or an area where you have excess profits? And what is the actual substance needed in the particular area? Because, for instance, manufacturing will be an area where we expect relatively little impact by Pillar 2, and you can kind of hint that also on the basis of the transfer pricing methods, for instance, that will be applicable to these areas. You will have, say, cost plus or TNMM on some basis, and a margin which is very similar to the one that was already under the substance carve-out, even in 10 years. In other areas like R&D or financing and headquarters, for instance, financing might be a routine activity, but requires quite often very little substance. So there, the answer will be a bit more nuanced. If the answer to the first question, we find ourselves in an area that is likely to be substantially affected, is yes, then we only move to the second question, which is, what is the type of incentive? And is it substantially affected? Now, Belisa spoke about things like loss carry forward, accelerated depreciations, participation exemptions as very little affected. It's because they are very hardly, in the strict sense, incentives, as they're the timing difference or alleviation of economic doubt taxation, but they don't really lower, on average, the effective tax rate when you take into account a certain number of years together. However, also some other incentives, like for instance, refundable tax credits, or very well grants, whereby you just provide further income to the company affected, will have a lesser impact on the ETR than things like tax holidays and sector-specific exemptions, and this must be taken into account. Belisa, if we can move to the next slide. Yeah, thank you. And here, the next slide is, if we find ourselves in a hypothesis where we are in an area that is supposed to be substantially affected and the incentive is supposed to be substantially affected, then we need to ask ourselves, do we go for a QDMTT? And this seems to be the approach that is generally looked at by the OECD and by many studies, including one performed by us. Or one needs to look at a more general corporate tax reform. Now, here I would like to make a little bit the case for a more general corporate tax reform, because I think the route under QDMTT has been quite explored. Because if you find ourselves in an area where we find a relatively little risk, for instance, we are having an incentive which is targeted at manufacturing activity, it does make sense to have the QDMTT alongside so that it can collect the marginal cases that will fall anyway under an ETR below 15%, and with an excess profit, because, for instance, this manufacturing activity has a higher margin than the one stipulated under the substance carve-out. But if we are in a high-risk area, so we see that this incentive will be substantially affected and is likely to be substantially affected, then the question is, should we go for the QDMTT? And the first point there is that that's an option, but then the outcome will be that the taxpayers' base will be essentially split on the basis of an arbitrary criteria, which are the Pillar 2 in scope criteria, which can create maybe not the most sensible tax policy from certain perspective. The other option is to have a corporate tax reform and withdraw the incentive altogether up to a 15% ETR. But then also the offsetting exercise here will be to see that you will end up in a situation when you withdraw actually the incentive also from instances that wouldn't have been within the scope of Pillar 2, and therefore they wouldn't have been affected by the QDMTT. So there is a balancing exercise here. The third option is, of course, also to switch the type of incentive that is being used to ones that are less affected by the Pillar 2. And here I would, for instance, refer to the qualified refundable tax credits. However, the downside there is that this will have generally a higher budgetary impact due to the fact that you need to actually make cash payments to the sectors that are enjoying this sort of incentive. But there is another reason to think about a general corporate income tax reform rather than going down the QDMTT road. And this is on the next slide, if you can change with Belisa. And this is the interaction between the CFC rules and the QDMTT, because if we need to understand this interaction in order to get a glimpse as to why in some instances a general corporate income tax reform probably makes a certain amount of sense. The reason is that the CFC rules as envisaged under GloBE are taking priority in time over the QDMTT. What does that mean? It means that the residence CFC taxation that is taking place is attributed at the level of the subsidiary for calculating the ETR, thereby increasing its ETR. And I give you a very simple example here on the slide. You have a CFC in a low tax jurisdiction, which is taking advantage of an incentive, a very simple example where they pay 0% corporate income tax. Now, this CFC jurisdiction decides to have a QDMTT. Why? Because it wants to collect all the incentives that it is providing rather than giving them up to another country. But does that actually happen when a CFC kicks in? The answer is no, because what happens here is that if the parent jurisdiction has a CFC rule that collects this income, we attribute the CFC income to the parent jurisdiction. The parent jurisdiction applies its domestic corporate income tax, say in this case 20%, and then this tax, for the purposes of calculating the ETR under the model rules, is attributed actually at the level of the CFC. What does that lead to? It leads to the fact that now the CFC ETR is above 15% because they have been taxed at 20%, meaning that under their QDMTT, they can collect exactly nothing. Therefore, a CFC jurisdiction in such circumstances has an incentive to amend its corporate income tax regime up to 15% rather than relying on the QDMTT, because in this way, it will neutralize both the CFC regime of the foreign country and will make sure that its incentive is not collected by the tax revenue of another jurisdiction. If you do one more click, Belisa, we will see, however, that there are some interesting examples with CFCs as well, which are quite thought-provoking, I would say. Because the example I just gave you is an instance where the CFC regime of the parent jurisdiction is triggered. But CFC regimes generally have a lot of conditions in order to be triggered, and multinationals are trying to go around this criteria in order to make sure that they don't trigger the CFC regimes. Now imagine that before Pillar 2, some profits of this multinational are attributed in the low tax jurisdiction, and it manages to make sure that the CFC regime of its parent is not triggered. For instance, the simplest example, very often a CFC regime, for instance, in Europe, will have a so-called substance carve-out. But when we say substance carve-out here, we mean that the CFC should have substance. And if it does, in the sense that it does have premises, it has staff, it has actually some economic activity. It's not just a letterbox. Then the CFC is not triggered as a regime. Now imagine that this was the case. The CFC company had substance, and therefore, although it was low taxed, the parent company's CFC regime was not triggered. Now, what will happen after Pillar 2? Pillar 2 is about tax competition. It's not about abuse. So we don't care whether there is staff, premises, and equipment at the level of the CFC. We only care that it was a 0% rate. Now, there would have been an income inclusion rule in case we do nothing. However, this very same multinational might choose to do something else. It keeps the CFC as is. It has the 10% of its profits taxed at 0 rate, but then it pushes down at the level of CFC jurisdiction further profits. They would have anyway been taxed at 20% in the parent, and makes sure that this time the CFC regime is triggered. So it establishes another company without substance, pushes down enough profits, in which way it makes sure that its ETR for the CFC jurisdiction is increased up to 15% because of these new profits that have been pushed down, while keeping and remaining with the initial, right? So for instance, it pushes another 20% of its profits down. In which circumstances, actually, it takes advantage of the functioning of the CFC regime under Pillar 2 as a primary rule in terms of attribution and calculation of the effective tax rate. This is on our side, and we're looking forward to the discussion. Thank you.
Thanks, Ivan. Thanks, Belisa, for your presentation. A lot to consider, and I think I can see interactions between all three presentations already. Again, just to remind everybody to pose your questions through the Zoom Q&A. There's, as I said, a lot already to think about. But I'll kick off with some questions of my own, and then hopefully there'll be questions from the floor as well. Maybe I can ask first about this issue of decision making amongst all of the jurisdictions in Asia, but as well as around the world. And Ivan and Belisa talked about these key decisions that people have to make about whether you do this at the corporate tax level or you do implement a QDMTT. Jay also mentioned that Mona's paper's finding also showed that there is minimal net impact for developing countries, but there seems to be quite a lot of likely effort in terms of implementing the rules, making key decisions, tax law changes, confronting bilateral tax treaties. So, how do you think this is all going to play out? And maybe if I can ask, Ivan and Belisa to talk first, and then maybe Matt and Mona, you can chime in after that. Ivan, you want to go first?
Yeah, I mean, let me understand your question correctly. So you are asking essentially what will be the impact on bilateral double tax treaty negotiations?
Yeah, it's actually more general, the question, Ivan. It seems to me, a layman, that there is going to be a lot of work on the part of jurisdictions, policymakers in those jurisdictions, as well as the companies, to figure out. But here we're talking about specifically the countries themselves, the jurisdictions. There's a lot of work to be done, right? Decisions to be made as to whether we go through the trouble of implementing changes to our tax laws, corporate tax laws, or implementing a QDMTT, and all of the attendant changes that would necessitate, right, in terms of impacts on bilateral treaties and all that sort of stuff. It's a lot of effort for not a heck of a lot of gain. So how do you convince people to kind of just do this?
Well, from my perspective, it's a question of first understanding where you stand. So you don't really know the amount of gain that is being made unless the analysis is performed. And here I would like to refer also to the last point that I was making regarding CFC regimes, because already some of the low tax jurisdictions will be affected by CFC regimes as they stand. Now, on top of that, they'll be affected by potentially the minimum tax. And a better time to consider a corporate tax reform, probably there will be none. Because now in one shot, one can think of essentially making sure that their incentives are not recollected both under CFC regimes and under an income inclusion rule. And to do that, simply going down the road of QDMTT is not enough. Because as I mentioned, QDMTT doesn't solve CFC taxation. And in that sense, it might be a good idea, if we are going to do that anyway, well, just do it across the board and make sure that that we neutralize all sorts of foreign instances of capturing domestic profits which have been undertaxed. So that would be my argument. My argument is there is no better time than now.
Yep. Okay. Thanks.
Let me just add that I think it's important to know that the impact of Pillar 2 on countries will differ significantly among countries. So even within the same region. So what one country does as a response to Pillar 2 doesn't necessarily mean that the other country will have to follow the same thing, because they have different approaches, and there may be different MNEs in their territories. There are different activities, and etc. So what I would suggest for countries to do, maybe it's to adopt the QDMTT and take the wait and see approach and see how things go with Globe once Globe is implemented, and then perhaps think about other alternative proposals. But maybe as a starting point, the QDMTT might be advisable, because at least the country keeps the revenue within if something happens.
Mona, any thoughts? Again, your analysis shows what would happen if countries were to adopt QDMTT.
Yes. So I think if you want to convince some countries to apply Pillar 2, it's easy for some, it's very difficult for some others. I would say that developing countries have not been satisfied because they're not going to get much revenues under both scenarios. And even in the QDMTT, so we show the results, but we don't take into account the CFC rules, which will even could decrease more the revenues. So this is also a negative point. Now, the positive point is for some developed countries, not also all of them. So some European countries, the US, some other maybe countries will, because they have a lot of multinationals, and because these multinationals are tax aggressive, so they are in low tax jurisdictions, yes, these countries that have many multinationals that are tax aggressive have a very, they would be really willing to implement Pillar 2 because it will bring a lot of revenues for them. Another, of course, positive, general positive outcome of Pillar 2 is that, okay, we're going to have like a 15% global minimum tax. It's going to bring maybe revenues to countries that were struggling to attain this level because they wanted to try to compete with other countries. So they were kind of like forced to decrease their tax rate. But also we can think about it in another way, which is some countries want to have a low tax rate, and it's like forcing them to change so it's also like a democratic choice if people voted for this. So there's a lot of positive and negative, and it really depends on each country. So I would say there's some positive and negative aspects. I'm not taking like a position on any, just showing the revenues for each country.
Indeed. Thanks, Mona. Matt, any thoughts?
Yeah, look, it's a continuation of since 2012, right? I mean, this is all still based off unfinished business with BEPS and profit shifting and base erosion. And so this is a continuation of a reduction of the ability or the desire for multinationals to want to shift profits from higher to lower tax. And by putting Pillar 2 in, you force jurisdictions to join the party up to 15%. The mechanism of how you do that, the global rules give you some options, right? The income inclusion rule, the under-tax payment rule, but I tend to agree with Belisa. It really, I mean, the noise coming out of the OECD and from the development partners is QDMTT. And the reason that is because you protect your tax base, you turn off the income inclusion rule, you turn off the under-tax payment rule, and you keep any revenues that you happen to collect through those low tax profits. And so I do think this is the drive is still there, which is to eliminate or reduce BEPS. The way you do that is QDMTT, and then obviously the development agencies are also saying you need less reliance on tax incentives, and you need to focus on domestic resource mobilization, and QDMTT will support that. That seems to be the line coming out from the development agencies.
Indeed. Maybe I can comment just to close off this discussion. But it seems to me, given what you've all just said, if QDMTT is applied everywhere, then we would still have achieved a redistribution, reallocation of taxes, corporate income taxes, but it's not necessarily in again a layman's perspective fair or equitable. That the final QDMTT result is equitable and fair. Developing countries don't enjoy anything. In fact, possibly may lose out even a little. But you have certain centers that do actually end up gaining. That is aside of future changes from in terms of the corporate actions. So again, I don't know whether anyone wants to make a comment or reply to that, but that is from my perspective anyway.
And maybe just a little point on something that I was thinking now listening to the discussion. I think it's quite fascinating because also we can see from Mona's presentation these quite interesting findings on the actual numbers and how they change after the QDMTT, because I would suspect that this will be a play of multiple acts, right? There is a certain expectation as to how much revenue will be raised under Pillar 2. And if these expectations are not necessarily fulfilled based on the QDMTT, if I had to advise a developed country which expected more, I would have pushed for actually expanding the CFC regimes, because in this way, you will make sure that you neutralize the foreign QDMTT, and now you get the higher share of the pie. And then at the end of the day, you indirectly force the foreign jurisdiction to work at the level of the corporate income tax. But indeed, we cannot predict at this point how things will work out.
Thanks, Ivan. Anybody else? If not, maybe I can turn to Matt and ask you, Matt, your three recommendations, or the sort of the exemptions that you're recommending for developing countries. How do you think that would fit within the kind of how things are playing out in the discussions globally? Is it too late to be thinking about introducing something like this into the equation for developing countries?
I think on this particular round, it probably is. And I know that there is, if we think about environmental incentives, we know that all the countries have signed up for carbon neutrality or moving to reduce their carbon footprint, which for many jurisdictions also means actually putting in place environmental incentives, including tax incentives. But the globe doesn't take that into account, even though some inclusive framework members actually wanted them to. so that you have this connection between environmental and the globe, so that the policy works together, not against each other. And I do think over time, what's also clear, I think, as well, is the globe rules have many challenges. There are many technical issues, as my fellow panelists have noted, as were noted by Jay, that will only wash out as they're implemented domestically and put through into the legislation. And so I think what the OECD has been quite clear in the fact that there'll be a continual review as issues technical issues and structural issues appear and occur because of the implementation. And I would hope, I don't know, but I would hope that there's an opportunity to continue to visit these issues, particularly as countries come under more pressure to achieve their environmental incentives, as countries also start to change their structure with the incentives disappearing, or the very low incentives disappearing, that they'll be able to revisit this over time. But certainly I would suggest not in the immediate future, hopefully over time.
Indeed. Yeah, thanks, Matt. So again, I'll ask if there are any questions from the floor. And in fact, if anybody else wants to make a comment, just raise your hand, or let us know if you want to make a comment. If not, I will ask another question. Yeah. And yeah, maybe not at the moment. Okay. So what I'll do is pose the question that I posed to Jay, earlier on, and really this is about timing, right? About implementation. Clearly, that there has been some talk about implementation in 2023 being postponed. What do you all think about the prospects of implementation like this? Given all of the complexities that we've just talked about, how likely is it for this to happen, and what is the urgency for different stakeholders? Mona, do you want to go first? I think you have a front seat from where you sit.
Okay, so from the EU perspective, yesterday there was the ECOFIN meeting, and the Pillar 2 was not on the agenda, so it was not discussed to vote again on. So in the EU, it seems that there is going to be a delay. I mean, from what is clear until now. So the implementation most probably will be delayed. It will depend on if all the EU countries would agree, because until now there are some countries that are really in favor. There are some few that are not very convinced yet. So this is the picture from the EU. And maybe another point on the implementation, it is still interesting to see how the guilty is gonna come across with the Pillar 2 rules, because guilty so far has been on not on a country-by-country basis, whereas the Pillar 2 is gonna add a top-up tax of 15% on a country-by-country basis, not on the whole multinational as the guilty. And yeah, this is my comments on the implementation.
Thanks, Mona. Anybody else want to chime in? Yeah.
I mean, I think from the Asia Pacific perspective, I think we've had clear indications from South Korea, for example, Hong Kong 24 is that there've been sort of public consultations in other jurisdictions suggesting 24 seems likely for the income inclusion rule, the qualified domestic minimum top-up tax. I guess from an urgency perspective, that still feels realistic. 2023 didn't feel realistic in terms of we still even haven't had the implementation framework on the safe harbors, the simplifications, the global information request, the implementation framework, which is theoretically due out later this month, but we'll see. So I guess my view is that still seems most likely. 2024, why do I think it still seems likely? It still seems likely because I think Ivan mentioned it earlier perhaps as well, is that there is some there are some budgetary challenges for various governments. They'll want some of this revenue, whether they likely collect it under the QDMTT. It feels to me that the cat is out of the bag in terms of this sort of minimum tax being implemented. A lot of jurisdictions perhaps see it as just catching up with the US GILTI in some way. It's a minimum tax requirement. And so it feels to me it's base broadening, and it goes to domestic resource mobilization. So it still feels like it's going to happen, but perhaps it's more like 2024.
Yeah, and if I just may add a few words on that. First, I will completely agree with Matt on this point. Part of the urgency, I can imagine, from a European perspective, is also exactly revenue mobilization and the fact that you can essentially increase your revenue without having to tap into the domestic base necessarily, which is quite of a sweet position to be in, especially given the economic circumstances which have deteriorated due to the Russian invasion in Ukraine last year. The second point maybe is related also to Mona's point on the ECOFIN and the fact that it was postponed. I don't think it had anything to do with the fact that there was no consensus on Pillar 2 as such. It was more of an issue with basically Hungary blackmailing the European institutions for completely different reasons related to their recovery package and the European funds that have been frozen. So they're just taking advantage of the fact that there is a need for unanimity there. So in terms of Pillar 2, there were at the beginning some concerns by a number of European governments, but this must have been cleared out months ago. It's just a question of unfortunate set of circumstances there.
But also adding something, if Pillar 2 is applied in the EU on the foreign, to put the top-up tax on the foreign affiliates abroad, because of some rules in the EU, they will be obliged to also put a minimum tax on the domestic companies, because they cannot discriminate between foreign and domestic companies. So this is a point that is worth to mention.
But at the end of the day, also the thresholds do matter there, right? So depending on de facto, right? De facto, there will be a different treatment because simply a lot of these multinationals will be foreign. But yeah, indeed, the directive is proposed to apply non-discriminatory because otherwise you breach the treaties.
Yeah. So I guess there are a number of in-scope multinationals represented here today, and also their advisors and the consultants. I just wonder what you all think, and what is the message really to everybody, given the uncertainties with respect to implementation. Different jurisdictions need to make their calls at the appropriate times. Lots of tax law to be changed if necessary, and what are multinationals and their advisors to do in this context? How do we play this out? Yeah.
May I just add something from the previous discussion, and that it's related to what you said, Christopher?
Please go ahead.
Thank you. From what I've been reading, it seems that all other countries in the world, except for the US, is waiting for Europe to implement GLOBE. So these countries, they are probably analyzing how the European Union is doing and what they will actually implement, how the rules will be implemented in Europe to move forward. But countries also have to take into account the time that it would take them to change their laws, to pass the laws in parliaments, in congresses, and etc. Because changes like this, the Pillar 2 changes, they don't happen overnight. So countries have to take this into consideration. They cannot just simply wait for the EU to take an action, but they can wait to see if the GLOBE will actually come into play. But I think countries have to look at their domestic laws and the process to pass the laws in the meantime, because this is really important. They cannot apply the global rules if they don't have the global rules within their own domestic legislation. So I think this is really striking now.
Yeah, and I think Belisa makes an important point, and I think a lot of jurisdictions or many jurisdictions in the Asia Pacific are looking at their domestic rules at the moment in terms of, you know, whether it applies in the current Income Tax Act, whether it's an income tax, or whether it needs to be somewhere else, or a new act or something like that. And I think the message has been from some governments, Chris, that multinationals need to be looking at and getting ready. They need to be looking at their data points. They need to be looking at how they collect data to comply with the rules. And I think that's been pretty clear messages from some governments who are saying you need to be potentially prepared to comply in the next 2 or 3 years, which means resources, it means systems, it means data management, and getting ready for that, because I sense my view is still, regardless of the holdups in the EU or the reticence of the US, many jurisdictions will apply the income inclusion rule, the undertax payment rule, and the QDMTT, which at the end of the day means you're trying to find new data, new types of data that you don't typically find, and then present that in a new format potentially as well. So that's something that multinationals will need to deal with and get ready for.
Indeed. Yep. Thanks, Matt. Alrighty. So there's one comment from Chris Wu, who is another member of the working group, and he says, seems Pillar 2 allows countries that cannot afford to have tax incentives versus those who need it to level the playing field. That the latter applies to many in Asia. It's about competitiveness, but has the greatest impact on developing countries that have weaker infrastructure, lower per capita spending capacity. It's a silver lining in terms of this being an impetus for those developing countries to catch up, but he feels that Pillar 2 is nonetheless too a broad brush an approach, that maybe something a bit more nuanced, perhaps something like what Matt has proposed might be needed to be introduced to kind of help them along the way. So aside from just introducing QDMTT, they might have to have other exemptions as well in the meantime to help them through this transition period. With that, unless there are any other comments or points that the panelists speakers want to make, I think we can draw the session to a close. We will have another panel discussion later on at 3:45 Singapore time, where we will have 5 speakers on a panel moderated by Mr. Michael Welton from Deloitte Singapore, to talk about some of the issues that we've already discussed, but from their various perspectives. I think it'll be quite interesting. We have a number of speakers from different perspectives. So stay with us, rejoin us at 3:45 Singapore time. That's in 15 minutes, and we'll see you back shortly. Thanks.